So the next speaker will be the name will be Felix Neoh. All right. I don't know whether the public know him or not. All right. So it's okay. A little bit introduction about Felix Neoh. Just before that, the topic today will be sharing by this Felix will be how to generate consistent income from your million ringgit nest egg to fund your desired retirement lifestyle. All right, so we are blessed to have Felix Neoh from this Finwealth Management to join us and share his thoughts about this topic. All right, so a quick intro about this Felix before we begin. So he is the director of financial planning in Finwealth Management. All right. So at the same time, he is the holder of this CFP and CMSRL certificates. I mean, and also, certificate. All right. So he has 20 years of experience in financial service industry. At the same time, he is the frequent contributor to various financial publications and regularly featured in The Age, TV2, and BFM Media. All right. So if you love Felix sharing later, you can like Finwealth Management at the Facebook here. Later we will put on the link and you guys can just click on the link and go to the page there. All right. So without further ado, we welcome Felix to the floor. Yeah. Hello. Hi, Felix.
Hi,
Good
hi.
evening.
Good
Hi.
evening.
Yeah, I
Hi.
pass the floor to you, Felix.
Thank you.
All
So, good
right.
evening, everyone. Thank you for to the organizers, Cameron, for inviting me to participate in this event. I think the event has been going on since the morning, is it? So I do not know how many of you all have actually been following throughout the day, but I hope the next 1 hour, will be interesting. I was trying to figure out what is an interesting topic that I could actually share with you guys today. And when I was looking through the topics by the other speakers, I noticed there was one talking about how to actually build a million ringgit or $1 million investment portfolio. So I thought, okay, so if now you guys know how to build the million ringgit investment portfolio, the question then becomes, do you know how to draw down on that million ringgit portfolio when it's time for you to retire? So I thought that would be an interesting topic of discussion. So I'm going to share some thoughts in terms of how you can actually strategize, right, towards your golden years, if you like, right? So hence, my topic basically is how to generate consistent income from your million ringgit nest egg to fund the desired retirement lifestyle, right? Okay, so without further ado, so first things first, when we talk about retirement, right? The question is, have you actually thought in terms of what does a so-called dream retirement mean to you, right? Perhaps I can get some participation from the floor, right? Has any of y'all given some thought in terms of what does a dream retirement mean to you? Maybe you can type Y for yes. Anybody? Zero debt, yes. I can see some people are saying zero debt. Any other thoughts when it comes to retirement? Some people will say that, they hope to be able to do some traveling, right? Perhaps, be able to enjoy the type of lifestyle, that they wish to have. Travel worldwide, yes. All right, so thank you for sharing that. Now, so you have some kind of an idea, a picture, if you like, right, in terms of what retirement means to you. Next question is, do you know how much that kind of a retirement lifestyle will cost, right? Have you actually done some kind of a calculation in terms of how much that retirement will actually cost you if you want to have it, right? Perhaps you all can share in the comments, right? Whether or not you have done some calculations. Maybe you can type Y if you have, right? If not, no worries. At least 3 million. Thank you for sharing, Jam Jam. At least 3 million. Never think about it. Now is a good time to think about it, right? So perhaps you should start thinking about it, right? If you haven't, start thinking about it, right? But no to worry. The next question is this. So you have a picture of what retirement, a cool retirement means to you, right? Then perhaps if you manage to calculate it, then you have a number in mind. The next question is, how are you going to fund it, right? That means now that you have the money, how do you ensure that whatever that you've actually accumulated is able to help you achieve the dream retirement that you're thinking of, right? So now, before I actually share in terms of the strategies, I mean, we have to be realistic, lah. Retirement, we have problems, right? There are problems. And what are some of the problems? Before I start about the problems, before I talk about problems, there are some good news, right? There's always good news and there's bad news. So what is the good news? Good news is, hey, we're going to live quite long lah in retirement. Why? Because everybody is actually healthier these days, right? Life expectancy is actually extending, right? So as of now, the typical average Malaysian will live until 78 years old, 76 years old, sorry. Uh, but over time, in actual fact, people are living longer, right? Our former prime minister is already 96, 97, right? So people are living longer, and we are actually having so-called healthier lifestyles, right? I don't know whether how many of you all out there are actually gym kaki, or every morning go for walk, right? So healthier lifestyles, eating better, organic food and what have you. Some people are actually going vegetarian, vegan, vegetarian, what have you. There is also a lot of advancement when it comes to medical, right? So as a result, now a lot of incurable diseases in the past are now curable, right? So that is the good news. But there is the downside of this situation, and that is the cost of living, right? We live in a situation, an environment where lifestyle inflation can be quite, Hokkien say jialat, quite high, right? We also have a situation where sometimes we wonder, hey, what's going on with the ringgit, lah, right? Especially when we go overseas. I do not know, prior to this year, if you go overseas, sometimes we might feel rather poor, lah, right? Well, everything costs a lot of money. I still remember, 20 years or so, 20, 30 years ago, ringgit was, 1 ringgit gets you 10 baht, right? If you go to Thailand, 1 ringgit gets you 10. But nowadays, do you know what the conversion is? Actually, ringgit has actually shrunk lah, by quite a lot, right? So that is one, cost of living. The other is medical inflation. So if you speak to your insurance provider, right, many of them will tell you that the cost of medical inflation is very high, 15%, 20%, right? Some big number lah, right? So you are wondering basically whether or not whatever money that you have accumulated, is it money that you can actually spend to enjoy retirement, or are you going to be so-called paying medical fees with the money that you have accumulated, right? So the question or the problem all of us have is, do we have enough money saved for retirement, right? Now, truth of the matter is that, right, our wealth situation is like this lah, for the majority of us, right? We start work, right? I'm not sure about you. I started work at 22, but for many people, they start work at 25 perhaps, right? And then they hope to retire one day. I just put the official retirement date lah over here at 60. Many people are now talking about financial independence, retire early. So they want to retire much earlier than that, perhaps 50, or the former retirement age, 55, right? But the idea here is you want to retire at a particular time, right? And we hope that whatever money that we have accumulated until the time lasts us, sorry, something, there's a little bit of a lag, lasts us until our life expectancy, right? One moment. Okay, I apologize. There's a little bit of a lag between my laptop and what you're seeing. But anyway, The idea here is this, I'm sure you can imagine this. We start working, right? And then we are accumulating wealth, right? So that's where so-called accumulating your million ringgit investment portfolio comes into the picture. So we're accumulating all the way from the time we started work until the time we retire. Thereafter, we will so-called go through the phase of decumulation, right? So decumulation basically means that we are drawing down on the money that we have actually saved, right? The question for us really is this, right? What if we face a situation where our money runs out, right? Instead of being able to last until 85, which we think maybe that's our life expectancy, what if your money runs out at age 78, right? Or worse still, if you read a lot of articles, that comes up from the likes of EPF, they are saying that actually money even lasting shorter than that, right? So what if your money lasts only until age 67, right? How does that make you feel? Is this a concern? Is this a concern for you? Perhaps you can type yes, or what are your concerns about this? Yes, so I can see quite a number of participants actually typing Y for yes. So the question is, from whatever funds that we have accumulated, right, at the point of retirement, how do we actually extend the duration of the funds that we have accumulated, right? How do we make whatever we have accumulated last longer? How do we optimize our savings, right? So question for you then is, how long can the retirement funding last? Right? So how long can the retirement funding last? Now, let me just share some common sources of funding for retirement, right? So I'm sure the earlier speakers would have spoken about, investing in shares, right? It can be public shares that you can actually buy from the stock market, or it can be private shares, right? Sendirian Berhad businesses that some of you all are actually building, right? It could be funds that you could have in the Amanah Sahams or the unit trust funds, right? It can be your retirement savings, EPF, PRS. Some of you are a little bit more gung ho. You might go to P2P lending, for example, right? Some of you are familiar with robo advisory platforms, right? That you might invest in. Otherwise, you might actually go for some equity crowdfunding or private equity investments, right? Cryptocurrencies or properties, right? These are the common ones, right? Uh, every time I talk to clients about retirement, I also ask this question: hey, are you sure you don't do some part-time work? Right? Because can you imagine if you stop work at 50, 55, or 60, right? You have so many years in retirement. Your mind is still very active. Why don't you do some part-time work, right? Because if you're able to earn some active income, not the same level of income as you had earned prior to retirement, but if you can earn some income in retirement, that will help you delay the drawdown of your assets, right? So these are the common, if you like, sources of funding for retirement, right? Now, what about those who face the situation of having lack of funding? What are the potential problems that you might face? Number one, you might have to downsize, right? So from a nice big bungalow, or semi-detached home, right? Lots of space, garden by the side, and all that kind of things. You may be forced to sell that property and move to a smaller accommodation, right? Some people might even have to relocate, right? Especially for us living in Klang Valley, right? Cost of living, as you know, is much higher compared to so-called your hometown, some kampong or whatever. So you might actually have to relocate. It's a good idea for some. Some people will find it challenging, right? But that could be an effect of lack of funding. What else? you might have to go and sell some of your assets, right? And sometimes the problem is when you want to sell the assets that you have, you may or may not be selling it at the right time, right? So like today, I think all of us here would know that if you're trying to sell properties, right, it will be a little bit challenging, lah, right, to say the least, right? So the question becomes, if you need the funding and if property is the asset that you have, then you might end up having to have a fire sale, right? The third effect of the lack of funding is that, I'm sorry, you might have to go back to work. Now the question then is, some people will say, I don't mind working, right? I can work actively. I think that's not an issue, as I mentioned earlier. But the thing is that if you go back to work, the question is, are you healthy to do it, right? Are you doing it by choice, or are you doing it because you're forced to do it, right? And sometimes for the old generation, sometimes health is an issue, right? Now, moving forward, what else could be the effects of lack of funding, right? Obviously, you might end up depending on family, right? So obviously, there are some people who will say, that my kids are actually my retirement plan, right? Yeah, well, true-ish to a certain extent, right? But I think most parents nowadays, knowing the type of incomes that fresh graduates are earning and all that kind of things, I think a lot of parents will say that I prefer to be financially independent, right? But that could be one of the impact. And the last one I just want to highlight is that you might actually be very dependent on government handouts, right? So this year we've seen a lot of government handouts. I think it's fine, but to be very reliant on government handouts can be quite dangerous in that sense, right? So the question then is this: we're living a lot longer, right? However, we have a problem when it comes to the funding because we do not know whether it will last, right? We have assets. Now the question is, how do we develop a retirement strategy? So the idea is to convert the nest egg that you have already built, right, before retirement, and convert it to what you saw just now, the income stream, that will be able to help you fund the type of retirement that you wish to have, right? So I would like to share very simple concept, right? Something that you can actually do so-called on your own, DIY lah. I think a lot of things that was discussed and today in the summit involves you being able to learn how to do some things of your own, right? So this is, I would say, a very simple concept, right, that you can think of doing on your own. So I call it the 5-step retirement funding strategy, right? So what is the first step, right? Before you can actually have the strategy, you must understand how much you need on an annual basis, right? So I'm not sure whether you have already done the calculation. Some of you all mentioned earlier that you have actually calculated how much you need, but I think the majority have not, right? How much you actually need on an annual basis is an important number to have. So there are a few ways of calculating, right? One commonly used rule of thumb is what we call the 70 or 75%, if you like, replacement income based on the last drawdown salary, right? Last drawn salary. Now, this one I think is probably more suitable for those who are saving less than 30% of the current income, right? This is one method. Another method, right, that is potentially more suitable for those who are actually having a higher savings rate, right, above 30%, is that you might want to actually base this on your current living expenses, right? Now, whichever way that is more suitable for you, you then have to go and add some additional items, right? Number one, you got to add, if your loans that you have are not fully paid off by the time you retire, you have to add the cost of those loan repayments, right? You also have to add insurance premiums, right? If you have insurance premium to continue paying, you need to add that. And finally, you have to adjust the figure for inflation, right? So how much you need to cover your living expenses, plus loan repayments, plus insurance, adjusted for inflation, right? Now, perhaps at this point in time, I will just quickly mention that if you have any questions, throughout my session, feel free to put them on the comment section, and what I will do is try and answer those at the end, towards the end. Okay. Now, moving on, right? Uh, I thought I would not really put an example of how to calculate, how much you need, but I was told perhaps it's a good idea to show, right? So I've got a very simple example, right? Let's say, for example, you wish to have 10,000, for your monthly expenses in retirement, right? And you want this 10,000 ringgit to last you for 30 years, right? During which time your money is going to be invested, your principal, right, it's going to be invested, and you think that you should be able to earn quite consistently about 5% per annum. What is your retirement number, right? Does anybody know what would the retirement number be? Based on this example? So I'm sure many of you all would know simple calculators, like for example, the easy calculator that you can find in your app store and all that, right? So I just use this calculator so that it's easy. So basically, 10,000 retirement expenses, so 10,000 payment, you want to be able to receive 10,000 a month, and assuming that you can get an annual return of about 5%. So this calculation has not taken into account inflation lah. So we use the 5%, and period basically 30 years. So you need it for 360 months, right? 30 years times 12 months in a year. So you get 360. And when you get the present value of this, the amount that you would actually need to be able to have 10,000, right, ringgit to last you for 30 years is 1.8 million, right? So I'm not sure whether you feel that the 1.8 million is a big number, high number, or is it a reasonable number or a low number, right? But this is just a simple example, right? So if I can move on, right, in the interest of time, calculation is the first step. The second step is basically to set aside what you need as cash reserves. So I want to ask you this question, right? In the event that you have an emergency, right? Which asset will you actually choose to fund your emergency? Would you use property? Would you use your share investments? Would you use your insurance? Perhaps you have some cash value in your insurance policies, or would you access cash, right? Perhaps you can share which would you use. So Jam says you use equities. George says you use cash, right? Okay, so I'm afraid I wasn't able to join the earlier session with KC Lau. Not because I didn't have the time, but because I don't understand. I would not be able to understand because I don't speak Mandarin. But anyway, I think most of us will agree. I should say that we will likely use cash, right, to fund the emergency, right? Now, and that's a very important thing, right? You need to use the cash simply because if you depend on so-called disposing your property, as I mentioned earlier, now is probably not the best time to sell the property. You might not even get an offer, even if you try to sell it at the so-called discounted price. Why do I say that? Probably because there's someone else who's actually selling it at even further discount than you, right? So shares depends. I was looking through a portfolio of a client of mine, and in actual fact, many people, you might experience this as well, are actually facing quite heavy paper loss on share investments, right? So you need cash. So how much should you set aside for cash, right? The cash reserve requirement, you have to cover the living expenses, you know, together with the loan repayments that I shared just now and insurance premiums. And ideally, you should try and set aside around 3 years, right? For this purpose. You should also add any kind of lump sum payments, right, that you might need to make in the next 3 years. For example, if you intend to purchase a new car, right, you might have to add that to the calculation, right, for your cash reserves, especially if it is an expense that is happening in the next 3 years. If your kids have not yet gone to university, but you are already about to retire, again, you also have to add that as part of your cash reserves, because you don't want the situation where you have to tell your child, I'm sorry, can you just stay in Malaysia to study instead, because you don't have the funds. You can't sell the shares, you can't sell the property, right? So I'm sorry, there's a little bit of a lag in terms of the presentation. It's not flashing out as quickly, but the idea here is that you should be adding you should add the living expenses, right? So I'll just summarize it. You should add the living expenses, loan repayments, insurance premiums for 3 years of the expenses, together with the lump sum expenses that you might incur, right? Replacement of items, some people might want to go and do home renovations. You can have to add that in, right? And then you want to add a little bit of a buffer in as well, right? Then you want to step three. I move on to step three, which is basically to try and determine what is your ideal investment strategy as allocation. So what do I mean by that? Sometimes I'm asked, hey, can I, as a retiree, should I still be investing, or should I be putting money in just fixed deposits? I think most of us know that fixed deposit rates these days are really bad, right? It's below 2%, right? And if I ask you how much is inflation rate, the cost of goods rising and all that is probably more than the 2%, right? So we need to have an ideal amount in various asset classes, right? Starting with the low risk. So we need to have some money there, but for the money that you place there, you should know that it is actually meant to be very safe, right? You don't want to take actually any bets with this money, right? So you should be expecting anywhere 2%, 3%, right? In the long term, perhaps you expect a little bit more, but for current market conditions, you're only looking at around the 2 to 3% kind of a return. So what are the typical products that are suitable for your low risk assets? Will be the likes of the savings accounts. Some people buy bonds, right? EPF is another good example, right, of so-called low risk investments. Or some people like the Amanah Sahams, the fixed price and all that kind of things. Those type of products, they are actually a good example of low risk products as well, right? But you can't put everything in the low risk product, because simply the returns are going to be too low for you to keep up with inflation. So you do need some moderate risk investment products as well, right? So the moderate risk investment product, as you can imagine, will require you to take some level of risk. So there is some price fluctuation, if you like, in terms of the value. And in terms of the expected return in the long run, perhaps anywhere between 6 to 9%. I think it's a reasonable expectation. 6 to 8, 6 to 9 is around there. And what are the products or assets that normally fall into this category? Would be the likes of properties, perhaps REITs, perhaps some balance type of fund. So balance, what I mean is a very simple analogy is this, 50% of the investment is in equities, another 50% is perhaps in bonds. So it's relatively a balanced type of fund, balanced portfolio. But you still should consider having some funds in high risk assets, right? So high risk assets, will comprise of the likes of direct shares, perhaps some alternative assets. We talked about some alternative assets earlier, cryptocurrencies like equity crowdfunding, peer-to-peer lending, some private equity investments, perhaps those. Or, if you prefer so-called regulated markets, some shares or aggressive funds would be suitable. And you should be expecting a fair amount of volatility for this asset class. But as a result of that, it's fair to assume in the long run that you should be targeting a return of anywhere between 10 to 12%, right? So the asset allocation that I'm talking about here is also dependent on your risk profile. So you need to understand your risk profile. I'm sure that if you buy investment products, you may have actually completed a risk profile questionnaire that gives you an appreciation in terms of how much you can actually put in each of the asset class, right? So typically, I just threw out some examples. A moderate risk investor perhaps will have 10 to 20% in low risk assets, right? Perhaps another 10 to 20% in high risk assets, and the balance will probably fit in the moderate risk asset class, right? So third step, right, out of the 5 steps is to determine your strategic asset allocation. What is ideal for you based on your risk profile. Then we move on to step number 4, right? And step number 4 is quite interesting, right? This is probably the main part of the presentation today, is to create your retirement funding buckets. Now, what does it mean by the retirement funding bucket, right? So if I can give you an analogy, right? So basically buckets, so you have 3 types of bucket. One bucket is really to try and cover your first 3 years, right? Your immediate 3 years, right? This year, next year, and the year after that, if you like, right? So it's the immediate funding bucket. The second bucket comprises of so-called the next 2 buckets, which is to cover your needs, your funding needs for the next 7 years, right? So if you think about it, bucket 1, bucket 2 covers your 10 years, right? And anything beyond there is so-called under the bucket 3, right? The idea here is that you want to be able to progress seamlessly, as you go through your retirement phase, right? Access your bucket 1, right? And know that the bucket 1 is going to be so-called refilled with money coming from bucket 2, and bucket 2 is going to be refilled from money coming from bucket 3. So what does this mean? Let me go through in further detail, right? So as I had indicated, bucket 1 is really to try and cover your immediate expenses, right? So it's to cover the cost of living. So the calculation that we had just now, the $10,000, 10,000 ringgit a month, right? The loan repayments on a monthly basis, if you haven't fully settled the car loan, the housing loans, and what have you, the insurance premium costs, the annual holidays that you're having, right? This type of cost, right, is what is going to be used or covered under the bucket 1. It is also to cover the lump sum funding requirements that happens in the next 3 years. So it could be to cover cost of replacing a car, if any, or some home renovations, right? Some people, as they work towards retirement, they want to renovate the home. Some people have to make the home so-called aged friendly, right? With the railings and all that kind of things, right? Some people will find the need to replace home-related items as well, right? So that is another item that you have to put into this bucket, if you like, right? Now, obviously, medical costs is something that should also be considered, right? So prior to retirement, if you were in employment, right, you would have insurance policy, what do we call this? The group insurance policies, right? That covers your medical costs and all that. Uh, some people already have their own personal insurance policies. However, those policies will not cover your going to the GP, lah, the normal clinic and all that. So you have to set aside some funding for that. Some people, if they had purchased or tried to purchase a medical card a little bit later in life and they have already developed some medical conditions, they might find it a little bit challenging to do that. So if you don't have your own medical card, then you need to set aside some funds for that purpose, right? So the type of assets that would fit in the first bucket, as you can already imagine, right? What was shared when it came to the strategic asset allocation, right? The first bucket typically are the low risk type of investments, right? So you're talking about the bank deposits, the EPF savings, money market funds, or fixed price unit trust funds, your Amanah Saham, right? Good quality rated bonds, right? Or otherwise bond funds. So these are the typical type of assets suitable for this bucket, where the price does not fluctuate much. The idea here is this, right? When you are still in employment, right, or working, what happens is you will know, depending on when your payday is, if there's 25th of the month, every 25th, if you go to the ATM or if you log into your online banking, you will see money appearing in the account, right? But the first month of retirement, when you log in on the same day, 25th of the month, will you see that? No more, right? So you need to create that stream of so-called funding to cover your living expenses and all that. So how does this bucket get so-called drawn down is through, if you like, the monthly transfer from the investments, the bucket number one, to your transactional account, right? Where you normally go and access to cover your living expenses and what have you, right? And obviously another expense that will draw down this bucket is some ad hoc expenses that might be required over time, right? But you cannot just keep drawing down, right? Otherwise, you will have a problem with this bucket because it's supposed to is meant for you to cover the rolling 3 years. So every 3 years, as time passes, this money in this bucket should be so-called worth 3 years of your expenses. So you need to top it up. So how does the top up in this bucket happen? It happens via the investments that you have. So if you invest in shares, right, then if you're focused on share dividend investing, then dividends will help you replenish this bucket. If your money is still with EPF, which I strongly encourage that you should have some money with EPF, then the dividends declared by EPF will cover, be used to top up or replenish this bucket, right? If you invest in unit trust and if you take profit on the unit trust, the profit from the unit trust can be part of this so-called funding for bucket number one as well. Some of you out there, I think many of you out there will have rental properties. If it is already fully paid for, then the net rental income can be money that can be used to replenish your first bucket, right? So that is actually essentially bucket number one. Then we move on to the bucket number two. Bucket number two basically is meant for investments that you can actually make and stay invested for the medium term, right? So 5 to 7 years, if you like. So it actually houses, right? It's where you keep your main income generating type of assets, right? And what you might find is that perhaps some of you out there might have properties, for example, as your main investment vehicle. Then one day you cannot just depend on the rental. It might be insufficient, right? So you might have to dispose a property. And if you dispose a property, right, for example, 1 million la, or 500,000 or whatever, you're not going to utilize it immediately, right? Some you will actually put into bucket number one, right? But the others will go into the bucket number 2, right? And then you have to use it for investments to be able to generate some income and capital gains for you, right? So typical assets that will go in bucket 2 would be the likes of direct shares, right? Would be for those who don't like direct shares as an option, then you can actually go into managed or what we call the collective investment schemes, right? Unit trust funds, the Amanah Sahams, and all that. You can also have some rental properties in this bucket, right? EPF savings is another good example, right? I'm sure at this juncture, I will just mention that you know that EPF does have a monthly withdrawal scheme for those in retirement. So instead of having to withdraw all the capital and then you have to worry, where am I going to put this money, right? How am I going to invest and get the 5% type of return? So you can actually leave it in EPF, right? And draw the dividend, if you like, take out a monthly dividend payment from there, right? So these are the typical assets that will form bucket number 2. So again, how does bucket 2 get drawn, right? Typically, you would draw down from bucket 2 to replenish the needs of bucket 1, right? And how does bucket 2 get top up is, as I mentioned earlier, disposal of some long-term assets, right? From the following bucket, bucket 3, typically properties and what have you. It could be also disposal of some illiquid assets, including profits from the sale of assets. So, for example, if you have a property that you purchase and $1 million, and now you sell it for 1.5 million, the profit from there is also going to help you replenish the money in bucket 2. So bucket 2, the money comes in, it then has to be invested, right? But liquid kind of investments, right? Not something that is going to tie you down for too long, right? So that's the idea of bucket 2. Then comes bucket 3. So this is really money that you can put aside for the long term. Why? Because it might be, on your 11th year of retirement, right? So it is actually meant to help you grow your long-term investments, right? And to try and so-called keep up with long-term inflation. Some people think of this so-called bucket 3 as assets that you want to use for your wealth transfer needs, right? Typical Asian families, they do not want to so-called leave nothing for the family. They might want to use whatever liquid investments that they have, but they will say, okay lah, son or daughter, I leave a house for you lah, right? So if that is your kind of mindset, your thinking, right, then perhaps your home is in your bucket 3, right? So common assets for bucket 3 would be the long-term type of investments already. So you can imagine the aggressive type of funds, the alternative type of assets where you may or may not get your investments, because some private equity investments is quite common that the fund manager might actually ask for extension of the duration of the investment period and what have you, right? So private equity, unlisted shares. I'm sure there are many of you among the listeners who are business people, right? So you might actually be building your business in a Sendirian Berhad kind of a business, and you perhaps want to pass that business over to the next generation. So, that's a common asset in this bucket. Residential home. Some people have insurance policies that will come due later in life. So then the funds from there will come into this bucket, right? So again, drawing down will be basically to fund bucket 2, right? How do you top up is basically through profit of disposal of assets. Perhaps later in life, you might receive some inheritance, so that can come over here as well, insurance payouts, or sometimes there might be some new assets, right, that will come available then. Okay, so the idea here is that with the 3 so-called bucket strategy, right, you will be able to fund the retirement lifestyle that you want, right? So if I can take us back to the earlier example of the 1.8 million so-called retirement funding need, right? If you're trying to cover the first 3 years of living expenses, 10,000 a month, right? For 3 years, 36 months, so 360,000 plus a little bit of a buffer, right? So perhaps 400,000 can be in your bucket one. Bucket two will basically comprise of anywhere close to the 900,000. Why? Because 7 years of your expenses, right? Seven times 12, right? 84. So it's about 840,000 plus a little bit of buffer here and there, right? And then the remaining portion can be in your bucket three, right? So this is one approach to looking at how you can actually fund your retirement. But it's very important for you to note that it doesn't end at step number 4, right? You really need to move on to progress to step number 5, which is the review. Now, what do I mean by that? Simply because your funding needs may be different at different stages of your retirement years, right? So you need to recalculate that, right? Whichever that is more relevant to you at that point in time. You need to also recalculate what's your need when it comes to the cash reserve. Perhaps earlier on, you might have put too much in cash reserves. Now it's time for you to rework that number, right? You need to rework the strategic asset allocation, right? And you need to review the retirement funding buckets as well. So that is an ongoing process that you need to go through, right? It's basically helping you to fine tune, right, your retirement funding drawdown strategy so that you can actually achieve the desired results that you want, right? Which is very much about extending, right? So extending the assets that you have. So really, the retirement drawdown strategies is all about having a smooth transition, right, from the wealth accumulation phase, right, that we started with while we are, actively working, to the wealth accumulation phase. And when you do this, right, by adopting the 5-step retirement funding strategy, you then have a higher probability, a better chance of extending how long, I should say, the assets that you have actually built, to be able to last you, right? So the idea here is that building different income streams, right, to help you generate the consistent income, from the assets that you have to be able to fund your desired retirement lifestyle. Okay, so I've actually come to the end of my presentation, and very briefly, perhaps I will take just a couple of minutes to introduce my firm to you, right? So the name of our company is Finwealth Management, right? We are a licensed and regulated financial advisory firm. We are regulated by Bank Negara as well as the Securities Commission. So we have the respective licenses from the Securities Commission, from Bank Negara, as well as FIMM, right? And we are licensed to offer independent advice when it comes to investments, when it comes to insurance planning, when it comes to estate planning, right? And one of the things that makes us different in the market is that we actually focus our services on what we call holistic financial planning. So what that means is that basically we help our customers chart a financial plan. We always start with the holistic financial plan so that basically we are able to consider all the financial goals that our customers have holistically. We help customers determine the right cash reserve requirement so that they know what is their ideal investable assets, right? We help our customer determine their wealth protection needs, their insurance needs, right? We also look at investments for them in terms of wealth accumulation, how to grow and optimize the money that they have actually saved, right? We also help our customers with their wealth transfer needs, right? Looking at the trust and the will needs of each of our clients, right? To make sure that they protect themselves as well as their family. And finally, we do this on a continuous basis. So therefore, performance monitoring is very important, right? We help our customers with implementation and we help them monitor the implementation. Okay, so that's what I wanted to say about our firm, right? Now, perhaps at this juncture, before I move on, I do have a small little offer for us, for you guys. But before I go to that, perhaps I will use the next 10 minutes or so for question and answer. So I'm looking through the questions that you guys have posed. Let me try and scroll it backward, scroll up and see what are the questions that have been raised. Otherwise, you can continue to post any questions that you have. Let me see. Okay, still trying to look at the questions. May I know what is the appropriate saving percentage for a fresh grad renting in KL? I would say that's a question that came from George, right? So savings amount, appropriate savings amount, I would say it's quite difficult to just put a number out there. What do I mean? Because it depends on your income level. You mentioned that you are in KL, right? So what that means is cost of living is not going to be very low. However, I do not know whether you are, okay, so renting, okay, so you're renting, some people are staying at home and all that. So it's very difficult to put a figure for it. And I don't want you to be too concerned about, what is that rate. I would answer it in this way instead, right? Start somewhere. Start with something. Whatever it is that you can actually afford, that you think you can afford today, right? Pay attention, make sure you're doing a budget, right? Then what you should do is next year, okay, so now it's not the best example, in terms of normally we'll say, wait for your increment next year and then put aside a big percentage, if possible, of the increment as your savings. I say now is not a good time to say that simply because I think we are quite happy if we still have a job, right, with COVID and what have you. But the idea here is put aside the increments that you get over the years, right? Start there, right? Try and reduce your expenses. Start with the increments. So if you are able to set aside a portion of the increments, that becomes your savings already, right? So George also asked how to accumulate huge sums of money. Perhaps you are the one who missed KC Lau's session in the morning, right? So lots of strategies. I think that's what Jess meant by missing out. How am I supposed to diversify? So Lim I Xian asks, how am I supposed to diversify my money into low, medium, and high risk assets? Well, basically, the first thing you need to do is to understand your risk profile. So assuming that you're quite young, do your risk profile, but if you are young, right, it's quite likely that you have the capacity to take a higher level of risk. So what that means is that you should actually take risk, by investing in, equities. If you feel that direct share investing is not your cup of tea, right, then go through unit trust funds and all that. There are lots of low-cost unit trust fund platforms available these days. We have the online platforms, we have Fund Supermart, we have robo advisors, all very low cost, suitable for those of y'all who are young and who so-called might not have too much to invest just yet. So you want to DIY, do it yourself, right? So you can actually go that way, right? How do we know that so Ollie asks the next question, how do we know 1.8 million is enough to last till we die, right? So that's a good question. The answer is we don't really know, right? But does that mean that because we don't know for sure, so therefore we shouldn't do anything? No, right? We still have to start somewhere. So what that means is this. In 2020, when you so-called download the Easy app, right, and you so-called work out your calculation, this is based on your current visibility of something quite a many years to go. But you still so-called do the working, cast the number, right? You come up with a figure. Now, does it mean that the 1.8 million is cast in stone? No. You need to revisit this number again, right? Because why? Today, 10,000 ringgit, if you think about it in today's value, 10,000 ringgit might be a reasonable amount of money. Some of you all might say, hey, I don't need 10,000, Felix. Why? 5,000 enough already, right? Every day I don't mind eating your mian pao, your roti, and your chap fan or whatever, right? Only once a week I go for Instagrammable meals, right? So you might think that your 5,000 is enough. But the truth of the matter is with inflation and what have you, later on that might not be enough anymore. So that's the reason why you do need to revisit the number, recalculate, right, as you grow older over time, right, as you work closer and closer towards your retirement age, then you would know your expenses better, right? Okay, so Abing's asked this question, what would be the COVID-19 proof asset in your mind in preparing for retirement? Because rental, equities, unit trust, dividend will likely be affected. How would it be, for bond or gold? So Abing, you actually have, you're asking me for the $1 million answer, right? It's $1 million question, if you like, right? What do I mean by that is that unfortunately, I also don't have a crystal ball. I also do not know which is the best, right? So what does that mean? It is because we do not know what is the best or the best, right? That is why we practice the strategic asset allocation. We want to have, the right amount of assets in the low risk asset class, but we must make sure it cannot be too much, right? If you're an only FD kind of a so-called investor, susah already lah, because now 1.8%, right? You will have a lot of problem growing your money. Your money can't even keep up with inflation, right? So you need to have that low risk asset mainly to cover your cash reserve requirement. Anything in excess, you need to go to the moderate risk assets and you need to diversify, right? Properties are there in the moderate risk asset class. Your balance funds, right? Your moderate risk type of assets, they are in the moderate risk space. But you must also have some aggressive funds, some shares, right? If you don't want to buy shares on your own, go through funds, go through the robo advisors, go for the higher risk profile category assets, right? So the way to actually have a so-called better investment experience is to be invested in diversified assets, right? In multiple type of assets so that you can get a better overall experience, right? Okay, Aisiang also asked this question. One thing that bothers me is that unit trust, can it be trusted? Because there are a lot of scams out there. Okay, so this one I am licensed to talk about. Okay, in the sense that, so unit trust, if it is unit trust, the actual unit trust, these are actually licensed by the Securities Commission, right? And it is a trust that is a so-called trustee involved, right? The assets are not held in the name of the fund manager, the fund management company. The assets are actually held in the name of the trustee company, right? So is the question if it is a trustable asset class? The answer is definitely it is, because it's regulated, right? There are a lot of other uh, so-called investment opportunities out there, right, that I would say do not have that same level of protection, right? So, uh, a lot of private equity investment opportunities have come up, right? The ones that can give you your 3% per month, your 4% per month, those I would say you need to study the plan more carefully, right? Don't only be attracted by the rate of the return that you can get, right? Be also very concerned about the return of your investment, right? Not just the return on investment, but also the return of your investment, which is, can I get your money back? Can you get your money back, right? That is a very important question that you should ask, right? Uh, Perhaps the last question that I take in the interest of time is a question from Jam Jam. Uh, Considering incorporating a year-on-year reflation rate to gauge the closest possible amount to cover us through. If I understand your question correctly, what you're asking for is how to calculate risk-adjusted kind of returns, if I understand you. And you are right. There is a way to actually calculate that. I don't have the opportunity to do that now, but and to keep things simple, that's the reason why I used a $10,000 example, right? Because there was no adjustment for inflation over there, right? But the idea here is you do need to pay attention to inflation, but every one of us will have a different inflation rate. Why? Because our lifestyles are different, right? Some of y'all will say, oh, you know, you're very frugal, right? You don't have to spend too much money, then your inflation rate will be less. Others, you know, if you always want to, you know, have your Instagrammable lifestyle, then your inflation, your personal inflation will be much higher, right? Okay, so with that, I would like to briefly, very quickly move on to an offer that Finwealth has for you, right? So I think that our conversation today basically might have actually, you know, caused you to think a little bit about your personal finances and, you know, ask yourself, what are your actual concerns today? Uh, for many people that we speak to, one of the problems that they have actually is that there is a lot of information. Everybody seems to be calling you to tell you, hey, you know, this is a very good investment idea, right? Why don't you invest in this, right? And then the next person will do the same, and the next person. So you are actually facing a situation where you have information overdose, right? So that's the first problem. The second problem is, like it or not, we are actually very busy people, right? We have busy lifestyles, right? Uh, and the problem for many of us is that we don't have enough time for ourselves, you know, let alone, you know, trying to have to manage our money, right? And the third problem here is this, right? We might come to, you know, seminars like this, attend seminars like this, right? Wealth Creation Summit. We get a lot of ideas. Oh, you know, these are the things that I can actually do, right? Then, oh, come up with some kind of a plan, right? But the problem is the Malay saying, hangat-hangat tai ayam, right? You might implement some things for a while, like for those who might have actually done share investing during the MCO, right? You might have actually, you know, been very active, but now we are in RMCO, right? Was it CMCO? RMCO? God, I can't remember. RMCO. So now you might not have that much time anymore. So what happens is you might not have the consistency or the discipline to follow up on all those actions. So these are the issues that you face, right? So the question you might be asking or you're wondering is, are you on track, right? You might have a financial plan, perhaps, but are you on track to achieve that, right? Uh, for those of you who are a little bit older, maybe in the 40s, then you'll be wondering, hey, you know what? I've already been working for, you know, 10 years, 15 years, 20 years. Did I miss something out or not, right? Have I missed something that's important in personal finance, right? For those of you who feel, I'm actually on the right track, but even if you're on the right track, I'm sure you're wondering, can you do better or not, right? So the offer that we have for you guys today is that we want to give you what we call the wealth check, right? We want to help you do a wealth check. So the wealth check is a report that covers 12 areas, right, of your personal finance, right? And what we will do is, based on the answers to the questions that we ask, right, we will give you a score, right? And we would then arrange for a one-to-one consultation, right? And you will have this consultation with one of our licensed financial planners, right? So a report together with a one-to-one consultation for 45 minutes, right? Now, usually this report would cost about 199 ringgit, right? We will charge 199 ringgit for this report as well as the 45-minute consultation. But for today only, today means the next 24 hours, right? We are going to give you a very special offer. It's an 85% discount. So instead of paying 199 ringgit, it will only cost you 29 ringgit. And this offer is available from now until 8 p.m. tomorrow, right? Sunday, tomorrow, 8 p.m., right? I believe that the link has already been posted in our chat, right, by the organizer, right? So the promotion code for you to enjoy this 29 ringgit offer is WCS Wealth Creation Summit 20, WCS 20, right? So with that, I come to an end for my presentation. I would like to invite you to visit us at finwealth.com.my. Go to our Facebook page, look for us, Finwealth Management, right? Like and follow our page so that you can keep up with us, right? So with that, I'd like to end my presentation. I thank you for your time and I wish you a good evening.
All right. Yeah. Thank you so much for Felix sharing with us today about this financial planning. All right. So yeah, I believe all the questions from the floor being answered by Felix, and I hope all you guys got the answer. Yeah, a very good explanation from Felix as well. Yeah. So Felix, thank you today because you spent your 1 hour here today with a full of information for our audience, for our fans. Also, all right. Yeah. So
Thank
due
you.
to the time conscious. Yeah, all right. So stay safe to you, Felix, and rest well tonight. Okay, due to the
Okay.
time's constraint, maybe sorry, anything I have to you want to say?
No.
All right.